All right, Venugopal joined just now. Let's connect with him and let's understand what he makes of, well, I won't use the word shocking, but I would say the surprise election verdict, which frankly, the majority of market investors were not betting on. So, Venugopal, there are three things which are worth revisiting post yesterday's election verdict. What happens to the valuations, which is P multiple? What happens to the macro, which is fiscal deficit and other factors? And what happens to the earnings cycle? What do you want to start with?
Okay, I think that's a pretty good, points to discuss. So, firstly, on the valuations and multiples, it's all a question of how each of us, in terms of analysts or investors, have positioning and how we've been looking at markets through the year. And as you know, all through this year, I have been generally talking about, in general, a cautious view on the markets. I started with a book profit call with a view that large cap still might generate high single digit returns, which is 7-8% returns equivalent to FDs, which was Nifty 50, 23,500 target. At the same time, underweight SMID, that's a broader thinking that I've held through even until now. So why was this positioning broadly in place? This positioning wasn't really a negative macro view, wasn't really a negative earnings view. It was more about peaking of macro, peaking of earnings growth. Now, and when paired with valuations, we felt that we were slightly above fair value, but not necessarily excessive about fair value, especially for large cap stocks. So from a valuation standpoint, I guess I'm not really materially considering any change at this juncture. And that's largely will be addressed in the point 2 and point 3 around macro and earnings cycle, especially because my thinking is that if continuity of power is actually the narrative at this juncture, and I think that's going to hold through. We have the same PM. If at all, there might be some shuffling around ministries. You might have slightly higher power for the two allies, which are critical at this juncture. But overall, I don't really see any policy landscape changing materially enough for the market to derate materially. So that's why I'm not really changing from this neutralish to an underweight call. Otherwise, it was an easy call for me, given that I wasn't too positive on flows as well. So that's one view. So I don't see any reason to panic. Number two is broadly on the macro side of things. See, honestly, GVA all through last year has moderated. We ended up with 6.3% in Q4. Now the reality is that whichever ways I look at it, we're probably now closer to a level which is more or less sustainable given the broader drivers. Remember, we have not even yet seen a rate cycle, decline as well. So those are the levers which come through late in the year from a support point of view for macro. And more importantly, the macro is also supported by a lot of these cycles which have started almost after a decade. Of course, these cycles have been going on for 2 years, but they're still early cycle. There are a lot of these cycles which are primarily going to be driving and supporting macro. If you were to think that from a policy standpoint, there's going to be some tweak which we can discuss, which might help some parts of consumption. I think that's very episodic and very short-term thinking. But the reality is that's a weak area of the economy. But with monsoons potentially being decent, at least one part of that risk also goes away. So I'm not really thinking of macro decelerating materially from here. We'll hold up at these good levels. Earnings growth, the third point you highlighted, I've been talking about earnings growth moderating for mid caps, primarily because I think the margin drivers are no longer there. And simply for the Nifty sort of stocks, I think a mid-teens growth I've argued that is more or less achievable, especially for this year. Looking at how things are, in terms of the broader involvement of government and how that could alter the revenue landscape, I really don't think there's any room for a material cut as well, right? So I've been arguing for no further upward revisions though. So that's basically, it's a very long answer, but then I just want to address all three of your bullet points.
So let's extend those 3 points.
Yeah.
The last part, the most important part, which is earnings. What is your earning assumption now for FY25? Have you changed it in a meaningful manner? And since your note talks about this defensive tilt, where the focus could be towards rural, towards consumption, how does that change the aggregate earning picture, assuming that there is going to be a change in gear?
See, if you think about it, I have a 13 to 15% broader earnings growth for FY25, which is a broad nifty bottom-up earnings growth thinking. Now the reality is that to a large extent this is driven by some margin extension and some top line growth compared to last year where it was largely driven by margins and not top line growth. Now, if you were to think about it, policy-driven areas which are largely oriented towards capital expenditure, of course, has two links. One is, of course, financial sector would be linked to it, and as well as direct stock which are linked to capex. Now, my thinking primarily around that is that a lot of these capex-led stocks are primarily order book driven. So their earnings this year is purely a function of what order book they've already achieved. You're not going to really see any material change in earnings there. Now, if capex, which is both government as well as private sector, is largely linked to that, ideally credit growth should not also change. So if you were to think about it, if at all you might talk about some extra boost to consumption, I have my doubts on that because I don't see policy landscape changing too much. But that could probably, if at all, support any areas where we might see probably some drips. So there's no reason for us at this juncture to second guess and take any different view on earnings growth at this juncture. I might have a view that this 13 to 15% earnings growth is not sustainable for 15 years from a CAGR point of view. Right? That's the reason why I'm not really arguing for a very large return this year.
Sure. But Venu, tell me, do you make any tactical changes to your, portfolios right now or recommendation list? I mean, do you now look at bottom-up stories, financials which have not performed, or even, perhaps wonder whether the government is going to have a little bit of a populist tone to its budget commentary and bet on FMCG perhaps?
Yeah. So, so all eyes fall on FMCG, which is not too relevant a sector in my view. But just to put it in construct of, thinking, we didn't really tweak anything. So if you look at my overweight positionings, financials is a relatively higher risk one because it's linked to the economy. But I have argued it from point of view of valuation comfort and decent earnings growth comfort. And the fact that, we are in a pretty good situation from a credit risk point of view, right? So, but then the rest of the sectors, which is telecom or mild IT overweight or even a healthcare overweight, is not really linked to what is happening to the bottom, from an economic cycle point of view, purely in India, right? So in that sense, I'm pretty well hedged. The way I look at it is that if we were to still broadly view this entire short-term narrative, the short-term narrative is that probably there's going to be a lot of subsidies. There might be a change in terms of how government looks at budget, and that could essentially potentially push some consumption. So is FMCG the right way to look at it? Is the right sector to basically invest? I think there are other ways to invest. You could probably invest in autos for that. You could invest in consumer electrical durables, small value discretionary for that, because those are sectors which are relatively cheaper and have faster earnings growth than your FMCG. So FMCG is not like something that is you should be hiding in. There could be short-term trades around it. You should sell those trades. So that's the way I would think about it, even though I don't really see policy altering materially for us to, showcase any different approach to sector allocation.
Fair point. What happens to this whole promise of capex is a multi-year theme, whether it is public sector capex or private sector capex? And frankly, large part of the capex already has been done by private sector. Government is just enabling them. So what happens to the private sector capex promise, stocks like ABB, Siemens, the entire, capex, the entire private sector capex basket?
Yeah, so I have a pretty unique positioning, and a lot of investors find it quite odd. I'm underweight industrials and I'm underweight consumer staples, right? So it's a unique positioning. So what is the thinking about this? This is basically a call, not just on a capex cycle, but this is potentially a call also on valuations. So our thinking primarily has been that we are positive capex cycle in the next few years, but the broader contours of capex cycle is going to shift from government-led to private-led. Just the heavy lifting on capex in the last few years has been government-driven and not private sector-driven. Private sector is yet to see industrial capex meaningfully recover. We are going to see infrastructure tilt from transportation to power sector, which is where private plays a meaningful role. Private no longer plays a meaningful role in a metro capex or a road capex or a rail capex, right? So in that sense, that's the flavor which is going to primarily change over time. So the way I look at it is that, in the capex side of things, we have to perhaps focus more on power and other areas where there is potential growth going through. Number two, we have to be still cognizant of valuations, because some stocks, especially the MNC names, are extremely costly. Of course, you can justify that to growth currently, but we have been very selective with respect to our approach to stock picking out there. So we're a bit more bottom up when it comes to both industrials and utilities, despite having a generally positive flavor over the next few years.
What is the broader sense you're getting from foreign institutional investors? They were bearish in the run-up to the election. Will they remain like that? Are they likely to sell more? Because for them also, this kind of an election mandate is something which will get them thinking.
So that is true. Volatility is going to be a pretty important sort of driver this year. You're going to see a lot of volatility, policy volatility, lack of visibility on that, what will happen to coalitions. So people are going to speculate a lot, honestly. The reality, as I mentioned, there's nothing to panic about, but there's been a lot of speculation, and people sitting out of India are going to be more worried. Now, put this in the backdrop of the fact that, as I've always argued, that FII's money flow is not an easy task to get in. Right? And a part of that is simply because we need to see the sidelining of the market for a while, for valuations to sort of get adjusted with earnings growth, so that you start to see more flows come in. Or if at all, FIIs would have basically been a bit more excited investing in new ideas, which happens through IPO market, which is also supposed to be buoyant, but let's see how that shapes up through the year. So in that perspective, I guess FIIs would be a bit more sort of, I would say, cautious when they approach India. But this is not really caution to the extent that they're thinking about India from a medium to long-term perspective is going to materially alter. The fact that India is a democracy, the fact that things would change in 5 years is something that should be cemented in everybody's views. And that is the reason I've always argued that never give a 2075 or 2050 view on India. It's quite foolish to do that. Just look at India in 5-year buckets, and currently we have continuity. So let's see how that shapes up.
Yes, indeed. Well, one can say about right now, it's extremely volatile for the equity markets at least. Venu, great to have you on the show. Thank you so much for taking the time out. Well,